Hey, everybody, welcome back. And really, the question for us this week is going to be, will the rates go up or down when the Fed speak? It's it's going to be interesting. We're going to go through that. We're going to talk about the weekly metrics for resale homes, new construction, and then, of course, we'll go over bank-owned homes and whatnot. In the meantime, let's get the show on the road. Okay, so each week we go through residential metrics along with one of the biggest factors that affect real estate, and that will be mortgage rates. Now, funny enough, every single time that the feds have reduced their rate, mortgage rates have actually gone up. And people are like, wait a second, George, wait, how's that possible? The feds dropped the rate. But wait a second. As one of my favorite comedians say, nay, nay. The feds do not control mortgage rates. They control what banks lend to each other every single day, or a 24-hour thing, right? With that, they will control when you get a home equity line of credit or HELOC, they will control that rate. And if you get a new car, they will control that rate. And if you have a credit card, they will control that rate too. But they do not control mortgage rates. And here's another case in point, because there were a couple of folks that were like, George, how is that possible? Explain that one to me a little more. Here's the simple thing. So feds, as you know, or may not know, meet roughly about once every 6 weeks. And they will make an adjustment once every 6 weeks. Whereas mortgage rates, as you and I both know, or should know, or will do know now, they go up and down every single day. And in fact, multiple times a day, just like the stock market, because yes, they are tied to the stock market. You look at mortgage-backed securities, look at your bonds, and that will tell you exactly what mortgage rates are trending at. The 10-year treasury, they are not tied to the 10-year treasury. They just freakishly follow it. Not all the time, but I would say greater than 95% of the time. All right, so just keep that in mind. So when we talk about, and we pull this one up, and it says feds will cut next week, but they will not be cutting mortgage rates. And what is super important about understanding that is that even though mortgage applications have gone up, and they came back down, they came back up. You see the chart on the right in red. You can see where they went up, they went down, they bobble along every single day. And then, of course, the bottom left, right, mortgage rates back to the highest levels in a week. Yes, because again, they trade and it's based on a lot of things. So we ended up getting some numbers, some CPI numbers in, had a beneficial effect. Following week, we had some other reporting and didn't do so well. Rates went up almost the entire week. Next week, or this coming week, the feds are going to meet. The question will be, will they reduce rate? Are they talking about doing a 0.25% rate? I think it's a 50-50 chance. Some people are saying, oh, I think it will. Some others are saying, no, I don't think it is. Personally, I don't see the benefit to dropping rate at this point. I think that they'll wait till January. They could very well. You better hope not, because I think that the mortgage rates will follow. They will head up a little bit steeper, unfortunately, because, well, that's what's happened. In fact, when we take a look at, let me pull up a different chart here for you. Hang on, let me go here. Let's pull this one up. I'm going to do them a little bit of out of order. I'm a little out of order kind of guy, but look at that. So here's the mortgage versus feds. Now, the top chart says, hey, listen, here's my mortgage rates. That's in orange, right? And as you can see, they were coming down until, yes, the feds dropped their rate. Boom. Immediately, they went back up again. We were in the low 6s, and then it creeped back up into about the mid 7s. Then it came back down again into the 6s. Whereas you can see from the feds, where they actually did nothing from July until September, right? Rates actually came down. And that is super important to understand, because even though the feds do not control it, they affect mortgage rates. And it depends on what the industrial investors think, especially when Jerome Powell speaks. We will talk about different elements. And that is also, again, why mortgage rates have such a massive impact on buying. Because as we come back into, let me get you back on target for our slides here. There we go again. When we talk about numbers, let's pull this one up. Oop, that didn't work. Let's try that again. There we go. When we take a look at November, right, where we actually didn't have too much of an impact from the feds. Here we go. Look, our numbers were absolutely great. They were absolutely great in October. And in fact, we expected some of these to change a little bit, meaning not as well as year over year, because it was in October of last year that we actually started dropping mortgage rates down, which increased the activity, whereas earlier in the year, so September through January, we weren't doing as well. October through December, we did really well. That carried over into 2024. Now, we have consistently been in the low to mid sixes, and we're still seeing quite a bit of activity. All right. In fact, here, this is going to be a little bit of fun. If I roll this back to here, for those of you in different areas and you want something maybe a little more site specific, hey, look, we've got Bellevue, Clyde Hill. We have East Side. We have South County. Just happened to have grabbed a few. These are 30-second market updates that are specific to certain areas. We will put those links in so that you can go ahead and take a look at them. It's just a lot of fun. The intent is to get you guys more information. We're also going to have one that says just for fun, because it can only be just for fun. We're going to go in certain areas. We're going to pick the seven best properties that sold for a certain month. Why? Because it's always fun to look at homes. That's why. And it's fun to create them. We'll throw them out there. And that way, it's like looking at the Homes magazine of what's sold, or, lifestyles or whatever they call those things. And you get to see them. Why? Because they're fun. Anyway, and that's all. There's no marketing. There's nothing in there like that. So let's get back on track here. All right. So last week we looked at rates versus purchase, right? So on the left on each side of those, as we look at the refinance, which is also like a new purchase mortgage, versus the purchase index, you can see how the two really do follow each other, not only in rate, but when they make differences. In fact, on the right, where it says 8%, boop, that's where we saw that crazy time, and we saw purchasing absolutely fall off. Then, as we've been kind of flattening back out because the feds didn't do much, we've been seeing some greater activity, or what we will call consistent activity. On the left-hand side, you can clearly see that 2023 was very, very low. When we hit the 6.02, that's also where you see the spike on 2024. And that, again, allows you to see how they relate to each other. Now, all that being said, if we know that rates are about par where they are historically normal, okay, now let's talk a little bit about real estate. What the heck is real estate doing, and how is that going to balance out, let's say, against sales, against what's going pending, what's coming active? But first, let's take a little quick look at Freddie. Everybody's yelling at me to pull up Freddie. All right, so here we go. Freddie's been lagging a little bit, but you can see, we're still a little bit less than where we were at a year ago. Roughly about, a third of a percent, 0.36. And you can see that we are actually just kind of plugging right along with that. With that, remember, as of 2025, we do have new conforming rates. That, again, will be super important for folks that are looking at qualifying, because your ratios will be allowed to be a little bit higher. And that's going to be very important, especially as rates start coming down. People will be able to qualify for a little bit more, get into some more resale homes, things like that, which will be different than new construction. New construction, they're buying down rates to incentivize and to pull people over from the resale market into the new construction market, giving some of those trade-offs. Anyway, moving on. So when we take a look at our actual metrics here, take a look at this, man. So last week, actual average combined days on market, hey, we're actually a little bit faster. We're 3 days faster on average. The year to date, we're 1 day faster. Why? Well, take a look. Look at the pendant. Man, we're at 2x. We're actually yesterday we were at 1,070, I believe it was. This morning it was 984. But, we had 550 roughly homes coming on market. And that is super important because understand this, okay? If we are taking off twice as many homes as what's coming on, that means that people's perceptions are pretty confident that, hey, our market is doing well, rates are at a good price, these are well-priced homes, I want to secure a home, and I want to fix that monthly nut each and every month as I start moving forward, getting myself into the market. Totally get that, right? The benefit is that it shows, hey, we're doing well. But then you might be saying, George, oh my gosh, is this crazy? Are we heading back to this insane seller market? No. We're seasonally normal. We are doing a little bit better on the pendants than we did last year. Okay. And in fact, if I pull this back up again and we pop over, let me let you guys take a bigger look at this. So, here's the 550 homes that we had that came on market. And then, of course, we have the 984 that went pendant, 780 that closed. And then, of course, we had a few folks that missed the market and did a price reduction. So, again, hey, subscribe. Tell us that you're watching this. At least hit the like button. We'd appreciate that. Helps everybody else to see it. So take a look at this. When we take a look at the average list price, the average list price actually came down a little bit, okay? But the average sold price went up week over week by $14,000. The year to date is about the same. It hasn't really changed, but for the month of December, prices are a little bit higher as far as the sales price, a little bit lower as far as the actual list price, right? So when we take a look at it this way, we're actually doing fairly well when it comes to pricing. Now, when we take a look at volume, right? We got the center chart here. Let's pull this up. So year to date, we have 6.1 more homes that have gone pendant, or roughly about 2,500. And when we take a look at the number of solds, that's when the tire hits the pavement, right? We're up 5.3%. That's roughly 3,000 homes. And that's actually, 2,000 homes. That's 3,000 homes. And that's a big deal because what that is clearly showing us is consistently through the year, even though we've had better interest rates than what we have seen in the prior year, people are still confident with where the market is at and with employment and with cost and everything else. And that shows that, again, that's why we're one of the 5 sweet spots across the United States. So if we actually then pop over and we take a look at new construction. Now, new construction, again, they're offering all kinds of incentives, right? We're going to buy down the rate. We're going to give you a gaggle of money for making improvements, putting up fences, updating certain things as far as maybe countertops, flooring, adding a fireplace. Maybe it's adding Wi-Fi, electronic little gadgets for you to play with, right? But when we come in here and we take a look at what our numbers are doing and we take a look at year over year, okay? So year over year, we're actually up for the first time, right? We're up 3.6% on actual price. That's actually good. Not for the first time, but it actually went above. Whereas the prior months, we were actually kind of dragging a little bit, and now they're catching up. We've got an average sales price in December for $1,069,000. That's pretty good. The year to date, that's 914. Part of that is an adjustment for some of the newer projects that are coming online, right? So when we take a look at volume, we take a look at velocity, and that is super important to understand is as we start taking a look at where are the numbers trending, the builders are actually starting to gain a little bit of that traction back. In fact, they did better this week than they did the week before because of some of the incentives. Now, understand, without a doubt, this is the best time to buy new construction. The best time right now before the end of the year. Hands down, there's the most motivation from builders to get product off of that ledger. They want it in the sold category, the pending category, whatever it is, they want it off of the active inventory. And they've actually been slowing production down so that some of their numbers don't look quite as bad as reporting for the shareholders. Because if the home isn't complete, then it's still under construction. See what I'm saying? So maybe they don't put the carpet in and the home is incomplete, right? And they can hold that one for a little bit as they're getting rid of some of the other inventory and offering incentives, right? And or if somebody's going to come in and want, better countertops, better flooring, maybe it's additional, equipment in the home. If you don't complete that house, you allow somebody to come in and finish those things, and those where your incentives apply, so you're not taking certain things out. Dang. Moving on. Let's get back to this. All right. So when we come back, and we start taking a look at some of the numbers that we have here. Look, so last week, their pended year to date was 2.1%. And right now they're at 1.7. So they gained ground. And as you look down below, it's almost 20% more sales that happened so far year to date in December. So they're playing a little bit of catch up. They're getting ahead. Now it might only be about 50 homes, but 50 homes is 50 homes because they're getting more people to take a look at what they are selling. And that is super important. Now, here's another important one, bank-owned homes. Okay, so let's be super transparent. All right, this is going to be a little bit longer, right? Okay, for people out there, for the credit unions and the banks that we work with, there's been a lot of information that has been coming out that people are saying, oh my God, it's going to be horrible. 2008 was going to be a joke compared to where the real estate market is going to be in 2025. And Warren Buffett, he's pulling out of real estate. And oh my gosh, it's mayhem and bedlam and cats and dogs are going to be raining. Okay, hang on a second. Understand, they're not talking about the real estate side of things. They are talking about CRE, commercial real estate. Two different things. Remember, residential, more than 70%, it's about 70%, 72%, I think, 70% I think was the number, that have mortgages that are 4% and lower. 70%. And that's of the ones that are financed. And there's the massive amount of equity in single family homes is there. Now, yes, commercial real estate can affect how much liquidity a bank has, how much money they can lend out for mortgages, residential mortgages, okay? I get that, but it's the commercial real estate. And that's not new. We've been talking about that for years, that there's a lot of, commercial, unlike residential, which you can, finance out for 30 years, fixed, right? You can do 20 years, fixed. You can do 15 years, fixed. Commercial, you can do most of the time, not a 30-year amortization. They'll do like maybe a 25, 28, 27, 25%. Or 25-year amortization, and then they put that on like a 5-year balloon. So 5 years, okay? Then you have to refinance. Unlike a residential home, you do a 30-year mortgage, you're good for 30 years. Now, commercial, it's not. They lower because they want more money up front, so they lower the amortization. The lower the amortization, the more money the bank gets up front. Plus, they put a balloon of 5 years, sometimes 7, every once in a while, but you'll pay for it in rate, you'll get 10, but 5 years is pretty common. That's a pretty common number that they look at. Well, if commercial lending was getting, 3 and 4% because it's prime plus or, prime plus 1, 2, 3, and the Fed rate was, pert near 0. So the banks were just saying, oh yeah, so here's my profit that I want on the loan. And investors out there were saying, yay, 3, 4%. Well, now they're at 7, 8, 9%. Okay. Well, when you look at those numbers where those interest rates double and you have $1.5 trillion of commercial real estate out there, that is the market. That's where they're saying it's going to hurt. Because even though they have to recycle that mortgage, refinance that mortgage every 5 years, which is exponentially faster than residential. There's also other criteria that go into it. Okay. So you have to have, earnings ratios, you have to have loan to value, and those things affect. So if your income isn't coming in, like when we do multifamily, we have to have a 1.3 earning ratio, meaning that for every dollar of debt, I have to take in $1.30 of income. And if you have vacancies, like in some of the office buildings, okay, if you have those vacancies, that means your income has dropped down. You may have a liquidity issue, and that's what they're running into. There is, yes, like in every real estate forum and every real estate season, there is an opportunity there. And yes, those are more expensive. They take more. And of course, financing is a lot more different. Okay, no different than what they're dealing with right now. And it's a normal cycle. And that is the industry that they're saying is going to have a massive impact. People's homes, that for the most part is, I would say, relatively secure. Commercial real estate, a little bit more challenging. Banks are going to have to be a lot more creative. They have that flexibility. It just depends on how much liquidity they have and how much latitude they get from the FDIC as they start to get close to that threshold. There you go. Long story to tell a very simple, very clear message of what is to be expected. So if you're going in, which then brings us to the next chart here, right? Let's open this bad boy up. Okay. Look, our foreclosures are nominal. I mean, that's nothing. I mean, we've had a whopping 281 homes sold this year, had 289 last year. That is not like what we saw back in 2008, 9, 10, started recovery in 11, where we had thousands of these, right? Where we're at 2 months of inventory, we were at like 13, 14 months of inventory, gobs and gobs and gobs of them. Whereas now, hey, I've only seen a couple of short sales recently. And of course, banks are in this area, hey, not very motivated. In fact, when we talk about, take a look at the bottom chart there. It says basically month to date, December, sold price versus list price, 100%. Last year was 96%. We're at 100%. That means for what it was listed for, it sold at the same price. Okay. So don't think that foreclosures are this absolute great investment, because banks know they can get their money back. We're just saying, they know it. They'll do pink carpet and vinyl. They'll get their money back. They market them well. Okay. Anyway, just saying. So with that, if you have any questions, put it down below. Make sure you like, subscribe, smash that subscribe button. In fact, have a little bit of fun with it. Ask questions. We get a lot of questions. We get more questions offline than we do. Post them online so other people know that it's fun and safe to answer or to ask a question, because I will get back to you. And in the meantime, it is getting very close. We have 10 days. 11 days to Christmas. And it's a little blustery out there. So make sure you stay safe. In the meantime, I'll see you on the next video. You guys have an absolutely fabulous day. Take care.